Welcome to The Explainer, where we break down the big ideas behind the headlines. So today we're diving into Australia's 5% deposit scheme for first home buyers. Now, it's pitched as this amazing way to get people onto the property ladder, fast. But the big question is it a helpful shortcut, or is it actually a path to financial strife? Okay, let's start right here. You know, the great Australian dream of owning your own home. It's not just about having a roof over your head, is it? It's deeply emotional. A recent Westpac survey found that a whopping 92% of Australians see homeownership as the #1 way to build wealth. It's just baked into our culture thanks to generations who saw property prices do nothing but go up. But what happens when that path gets a whole lot rockier? Because let's be honest, over the last decade or so, the entire landscape for first-time buyers has just completely changed. The hurdles are way higher, the debts are getting much bigger, and the whole idea of how property builds wealth is really being put to the test. And look, let's put some hard numbers to this. Back in 2015, the average loan for a first-time homebuyer was about $333,000. Now you fast forward just over 10 years to 2025, and that same number has absolutely exploded to over $607,000. The size of the debt that people are taking on from the get-go, it's pretty much doubled. Now, here's where it gets really interesting. Over that exact same period, those first homebuyer loans shot up by a staggering 82%. But what about wages? Well, they only went up by about 54%. And you don't have to be a math genius to see the problem there. When your debt is growing that much faster than your income, you end up in a massive financial squeeze. And this gets right to the heart of the problem with building wealth in today's market. Just get this. In a single year, the average new loan amount jumped by almost 25%. But at the same time, national property prices only went up by about 10%. So what does that mean? It means new homeowners are taking on debt way faster than the value of their home is actually increasing. And that just dramatically slows down how quickly you can build equity. You know, that all-important slice of the home that you actually own. And look, this isn't just some abstract theory. It has a real human cost. According to data from Roy Morgan, nearly a quarter of all Australian mortgage holders, that's 24.5%, are now in what's officially called mortgage stress. That means they're spending 30% or more of their income before tax just to keep up with their mortgage payments. So, with all of those challenges, you can see why a government program designed to help has become so incredibly popular. And that brings us right to the 5% deposit scheme. So let's take a closer look at how this so-called shortcut actually works. On paper, it sounds like a dream come true, right? Instead of saving up a massive 20% deposit, which can take forever, you can get into the market with just 5% down. The government then steps in and guarantees the other 15% to the bank. And it's so popular that in the last year, more than 1 in every 3 first-time buyers use this scheme. But to really get the hidden risk here, we have to talk about something called lender's mortgage insurance, or LMI. So normally, if you have less than a 20% deposit, you have to pay for this insurance. But here's the kicker. It protects the bank, not you, if you can't make your payments. With the 5% scheme, the government is the one taking on this risk, which means, if a borrower defaults, the Australian taxpayer is the one left on the hook. Okay, so according to some analysis from Morningstar, this shortcut doesn't come for free. It actually comes with 3 pretty significant hidden costs, or tolls as they call them, for both the individuals taking the shortcut and for the country as a whole. So the first toll is all about individual stress. I mean, it makes sense. When you start with such a tiny 5% deposit, you are taking on a much larger loan. And that means higher monthly repayments and, of course, paying way more in interest over the years. It leaves people incredibly vulnerable, with almost no financial buffer if they lose their job, get hit with unexpected bills, or if interest rates go up. The second toll is what's being called policy paralysis. Think about it. When a huge chunk of the population is carrying these massive mortgage debts, it basically ties the hands of the Reserve Bank. If the RBA needs to raise interest rates to cool down inflation, they risk pushing hundreds of thousands of families into severe financial trouble, or even default. It really creates this kind of no-win situation for the people managing the economy. And that leads to the third toll, a more fragile economy overall. With so many homeowners having only a tiny 5% equity stake in their homes, the whole system becomes much more vulnerable if housing prices take a dip. Even a small drop in the market could completely wipe out their equity, leaving thousands of people with negative equity, where they actually owe more on the loan than their home is even worth. And all of this, it brings us to this really strange paradox at the very heart of Australia's whole approach to housing. The scheme is supposed to make housing more affordable, but does it really? This quote here really nails it. These kinds of schemes, the ones that just help people borrow more money, they don't actually make houses cheaper. In fact, by pumping more buyers with more borrowed cash into the market, they just ramp up demand. And what happens when demand goes up? Prices can get pushed even higher for everyone. So it helps some people jump that deposit hurdle for sure, but it does nothing to solve the actual affordability problem. So the takeaway from all this analysis is that our housing policy feels a bit like St. Augustine's famous prayer. Lord, make our houses affordable, but not yet. We keep coming up with these solutions that just kick the can down the road. And that leaves us with one final, pretty uncomfortable question. If a policy that's designed to help actually ends up creating more personal debt, more risk for the economy, and more financial fragility, what problem are we actually trying to solve?